The US dollar has been the world's reserve currency for over 7 decades, but a new era is emerging that threatens its dominance. As of this year, Bitcoin and other cryptocurrencies have reached a combined market capitalization of over $2 trillion, with some estimates suggesting it could hit $100 trillion in the next few years. This rise of digital currencies has sparked concerns about the future of the US dollar. In fact, a recent survey by the Bank for International Settlements found that 62 of central banks are exploring or implementing digital currencies. This is no surprise given the growing popularity of cashless transactions and the increasing demand for secure, fast, and borderless payment systems. But what's driving this shift? Is it just a fad, or does it signal something more fundamental about the changing nature of money itself? One thing is certain: the rise of digital currencies has significant implications for the US dollar and its role in the global financial system. To understand this trend, let's take a closer look at some key statistics. For instance, did you know that since 2008, the amount of outstanding debt in the United States has increased by over $16 trillion? This staggering sum represents not only an enormous burden on the US economy but also a significant challenge to its currency. The total public debt held by the federal government now stands at an all-time high of over $28 trillion. Meanwhile, the value of the dollar itself has fluctuated significantly in recent years. In 2018, it hit a 4-year low against a basket of major currencies known as the trade-weighted dollar index. The consequences of this trend are far-reaching and multifaceted. For one thing, rising debt levels have led to increased borrowing costs for us consumers and businesses. According to a recent report by the Congressional Budget Office, interest payments on the national debt will balloon from $523 billion in 2022 to over $1 trillion by 2030. Meanwhile, declining confidence in the dollar has sent shockwaves through global markets. As investors seek safer havens, they returning to other assets like gold and bonds. In fact, a recent survey found that nearly half of institutional investors are now considering alternative currencies as part of their portfolio diversification strategies. But what about the role of digital currencies in this mix? Proponents argue that these decentralized systems offer unparalleled security, speed, and efficiency. No longer will people need to rely on intermediaries like banks or payment processors. They'll be able to make transactions directly with one another. One key player in this space is Facebook's Libra, a cryptocurrency designed to facilitate cross-border payments and reduce transaction costs. Launched in 2019, it quickly gained traction among investors and tech companies alike. Although the project was put on hold last year due to regulatory concerns, its impact on the global financial landscape remains. In fact, many experts believe that digital currencies will not only disrupt traditional banking but also create new opportunities for economic growth and development. According to a report by the World Bank, remittances sent via digital platforms like Demise in Kenya have reached an all-time high of $1 billion annually. However, there are significant challenges to overcome before these systems can achieve widespread adoption. For instance, regulatory frameworks remain unclear, and concerns about market manipulation and security risks persist. In fact, the collapse of BitMEX, a major cryptocurrency exchange, last year highlighted the vulnerability of these markets to volatility and external shocks. Despite these obstacles, many experts believe that digital currencies are here to stay. And with good reason. Did you know that over 200 countries have now issued their own digital currency or central bank-issued digital currency? T2. This is a significant departure from traditional monetary policy, which has long relied on physical cash and paper-based systems. So what does the future hold for the US dollar? Will it continue to dominate global markets, or will new players emerge to challenge its position? One thing's for sure, as digital currencies gain traction, the need for secure, transparent, and efficient payment systems will only grow more pressing. The rise of digital currencies has significant implications for the global economy. As more countries issue their own digital currencies, they'll be able to bypass traditional intermediaries like the US dollar and reduce reliance on foreign exchange transactions. This could have far-reaching consequences for trade and commerce, as well as for financial stability. For instance, a recent report by the International Monetary Fund found that hikes could potentially reduce transaction costs by up to 95. This is because digital currencies eliminate the need for physical cash, checks, and other paper-based systems. Instead, transactions are facilitated through decentralized networks like blockchain. But what about the impact on global economic growth? Some experts argue that TICs will stimulate economic activity by increasing access to financial services, particularly in underserved regions. According to a report by the World Bank, 1.7 billion adults worldwide still lack access to basic financial services, including bank accounts and mobile money. In fact, digital currencies have already begun to transform traditional banking models. For example, Morgan Chase recently launched its own cryptocurrency, Coin, which enables faster and more secure cross-border payments between the bank's clients. Meanwhile, other institutions like Goldman Sachs and Morgan Stanley are exploring their own digital currency initiatives. However, there are also risks associated with this trend. For instance, a recent report by the Financial Stability Board found that X could potentially increase systemic risk if they were not properly regulated. This is because decentralized systems can be vulnerable to market manipulation and external shocks. Despite these challenges, many experts believe that digital currencies will play an increasingly important role in global economic development. And with good reason. Did you know that a recent survey found that 70 of central banks are now considering DICs as part of their monetary policy toolkit? The rise of digital currencies is driven by significant technological advancements in the field of cryptography, distributed ledger technology, and blockchain. These innovations have enabled secure, decentralized, and transparent systems that facilitate peer-to-peer transactions without intermediaries. One key player in this space is Ripple, a company behind the popular Oxer cryptocurrency. Founded in 2012, it has developed a range of solutions for cross-border payments, including a distributed ledger technology platform called Rapid. This system enables fast and secure transfers between banks, reducing transaction times from days to mere minutes. But what about other digital currencies like Bitcoin? Proponents argue that these decentralized systems offer unparalleled security and immutability thanks to the use of advanced cryptography and blockchain technology. In fact, a recent report by the U.S. Treasury Department found that cryptocurrency transactions are significantly harder to track than traditional financial flows. However, there are also significant challenges associated with this trend. For instance, regulatory frameworks remain unclear, and concerns about market manipulation and security risks persist. In fact, A recent survey found that 75% of institutional investors consider regulatory uncertainty as